Hello, everyone. We're live. And welcome to the Hidden Yields Opportunity webinar. I'm Alex Loktev, Chief Revenue Officer of the P2P. Just a short intro, we are one of the world's largest staking provider. Also, we are building yield solutions across DeFi, stablecoins, and I'll be your moderator today. And this is a huge privilege for me to be a part of that great team. Just a quick frame, stablecoins are around 280 billion market, and yet only about 10% earn any yield. And with the Fed current rates near 4 percentage points, that is a lot of idle cash. And we joined by a great panel, by great guests today. Alex Scott from Superteam of United Arab Emirates, Eric Saraniecki from Digital Asset and Canton Network, and obviously our good old friend Jean-François from Ledger. And before we dig in, let's guys do a quick intros, about a minute each, and tell us how did you get here, what are the things about here, and maybe you could share something what you do with crypto, right? Let's go, Eric. Maybe you go first.
Yeah, sure. Thanks for having me. Very nice to meet everyone. Eric Saraniecki. I'm one of the co-founders of Digital Asset. I've been at this the better part of a decade. At DA, we're the company behind the Canton Network, the world's first public permissionless network with privacy that enables finance to flow the way you always thought that it did, but never understood that it actually doesn't under the hood. Nice to meet everyone.
Thank you, Eric. Jean-François.
Hey, so I'm JF. I'm at Ledger. I'm in charge of the wallet and consumer services. What we do at Ledger, we do security-based solutions to engage with your crypto. So we have a part of the activity that is a B2B activity with enterprise solutions and solutions for DeFi and the like, and part of the activity which is the consumer activity. And both of them are leveraging devices, the signers, that keep you safe. But for the rest, I think a lot of people have a ledger or heard about a ledger. So be very happy to discuss that today, and thank you for the invitation.
Thank you. And Alex.
Yep. Hi, I'm Alex Scott. Thank you so much for hosting us, Alex. Great to be here. So yeah, I'm representing Solana's interest in the Middle East. I've been here for the last 3 years living out of Dubai, and our activities are really focused on just increasing adoption very broadly. Could be from early stage teams, founders that are moving to the region and want to build on Solana, all the way up to institutions, more traditional finance entities that want to use Solana to increase revenue, reduce costs, etc. So pleasure to be here.
Awesome. And thanks guys for having the time to join us. And today we got a unique opportunity to oversee different parts of the market, different regions, and we'll get an insights from everything. And let's start with overseeing the opportunity. And Eric, I got a first question for you, if you don't mind. Canton just recently, yesterday, announced a partnership with Chainlink. And well, the Chainlink joins a super validator. They will bring their CC/IP connectivity, right? All the standardized data feeds. And this should, I assume, materially lower the integration cost for institutions, right? And in practical terms, how does this change the whole Canton ecosystem, and how could it help the bank turn idle client stablecoin balances into some compliant yield products? Because you guys in Canton, you got a Goldman, a JP, and that firms, they will never leave any backs on the traditional market without yield, right? But still right now on crypto, they're sitting on these millions or billions of potential earns, but don't do nothing. So how do you see that? What became possible right now, probably that wasn't feasible a year ago? And how does this recent change, shift in the whole ecosystem?
Yeah, two big questions packed into one. So keep me honest on whether or not I touch it. But very excited about the Chainlink announcement. For too long, people have kind of mischaracterized Canton as an island, and it's wonderful to have bridging and all the other wonderful services that Chainlink provides to our broader ecosystem available. I look forward to that going live as soon as that comes around. We'll start to activate that through the different ecosystem opportunities. It provides all the services you expect and love already from the Chainlink ecosystem. To your question around yield, I have kind of a spicier take on this in general, and I kind of like to start zoomed out a lot more. We in the crypto ecosystem, I think, tend to fall victim to this fallacy that stablecoins have found product market fit. And I think if you zoom in and look at it, they have in very certain ways. Like, if you compare the velocity of a stablecoin to M1, it's actually quite low. And so this whole narrative around, this is about being able to send money to anybody in the world with a click of a button very cheaply. We don't see that being the primary determinant of adoption of stablecoins right now, if you're looking at the velocity numbers. Instead, I think it has a lot to do with access, and access has been incredible product market fit. People living, this standard Tether narrative about people in the zone that are exposed to hyperinflationary local currencies that want safe, reliable access to the dollar instead. And I think they're more focused on hedging against the inflation of their local currency and less interested in getting a pass through of the yield of the underlying. Now this will change over time, but I think where we are very far away from product market fit are the higher velocity use cases around stables. Again, the narrative around we're going to start to use it in B2B payments and payroll and transfer pricing and treasury management and all that sort of stuff. And their yield is obviously much more important. That's an organization making sure that they maximize the yield and the utility of their treasury. So as we actually move into those use cases, then I think you'll see the percentage of this shift in that direction. But it'll only be because the TVL of stables will grow, and it'll grow in different ways than it's been adopted to date.
Thank you. And while you got a very deep, insightful overview of American market, mostly, Alex, if I got a question for you. Maybe you could bring us a bit more color from another pole of the globe, because looking to the United Arab Emirates, what's happening there right now? More and more crypto companies opening their offices, TradFi firms are starting to be extremely more proactive, and the whole regulatory landscape changed a lot. So it would be fair to say that UAE is opening the doors right now, while US, Europe adding some guardrails. How do you see that? Is that a real innovation on the local market, or is it mostly a regulatory arbitrage? What happens there?
Yeah, it's a good question. I think things are moving so fast here, so there's like a little bit of lag in what's happening on the ground versus what the reality, or like the perceived reality abroad, especially. I think this, the question kind of implies that, regulatory arbitrage implies that there's like, the only reason that you would come here is like some loophole, or there's like a lax set of rules, when the reality is that it's arguably like over-regulated here now. These rule books and like this attitude to regulating crypto has started since 2017, and like the result now is like multiple regulatory entities. Abu Dhabi has ADGM, Dubai has VARA, and there's like a federal layer of ESCA and the central bank, all with like often overlapping rules. So it's not this like Wild West kind of like no rules place that I think maybe it was at some point many years ago. So there's that is like a bit of a perception change. The question, is there a real innovation happening? I think I would just point at, regional specific stuff that's happening that's super interesting, like the tokenization of Dubai's title deeds, right? The Dubai Land Department tokenizing like more than $300 million worth of on-chain assets that is bringing global liquidity into the Dubai real estate market, helping raise asset prices. But then also reducing transaction costs, right? Like a lot of the fees that were on the exchange of title deeds and creation of those documents is now eliminated. And I think, like, will it change? Well, the advantage of being in a country with continuous leadership, right? There is no democratic process here, which, having been raised in the West, it's like, a lot of people would consider that as like a detrimental thing. The advantage that comes with that is you don't have like change in political winds every 4 years. You have this like continuity of leadership and vision and the ability to execute over like a very long time period. So I think it's probably less likely that you get these like really violent swings in regulatory stance in a country like this.
Got it. Yeah, and even extremely conservative entities like an energy companies, right? The developers bringing more and more assets into real world assets today in Dubai. And JF, you got a very specific overview to the market through the infrastructure, for the wallet perspective. How do you see an adoption right now, and from the wallet and from European angle?
Yeah, so our position is a bit specific because we enable end users to secure their crypto. And if you look at the position of Ledger users, they use Ledger to secure about 20% of global crypto through their device, which is significant. And that same proportion more or less applies also to stable. So it is, and it's not new. So I think it's not like there's a trend regarding stable. I think people have already onboarded for now quite a long time. The activity around stable is has always been existing. So I think the use case, very basic use case, but very efficient use case, is to expose yourself or not to the market. So we've seen a lot of movement around stable, and people reallocating times to Bitcoin, Ethereum, or other ecosystem, because I think it's also one of the sometimes forgotten specifics compared to all the other wallets of Ledger, is that there's a Bitcoin inside, but there's also, I think, a lot of other chains. And this capacity to move in and out, I think, has always been there. And now, indeed, there is more and more demand and possibilities to do something else, as I suggested, to engage in yield opportunities. So here on early results, we are seeing a very nice adoption, but also other use cases. And I think the things around payments, so with the wallet, you can also use cards, are important. If you look at also simple cases like send and receive, which we forget because there's of course a form of financiarization around crypto, but there's also when you look at it, so I won't maybe answer the European question, but I can answer the broader question. I think Europe is only part of our market. When you take a broader look at things, you see that stable is also a way of payment, a way of peer-to-peer, a way of exchanges. So there is this variety of use case, and it is indeed something big for a reason. So now, how do we offer more? How do we offer better? It's not exactly our direct role, because at Ledger, what we do is we welcome different services, different providers, different projects, and we help them engage securely with the user base.
Thank you. And we're working with institutions mostly, not the retails, but even in the institutional side of the market, getting a huge pushback against any kind of complexity. And being a retail, I think more or less every of us dealing with hardware wallets, kind of reducing of complexity looks like, and maybe one of the most important after the safety, right? I think if you want to scale an adoption, how do you see right now the risks of smart contracts, or there are some other risks which not getting clients into the yield enough right now? I think, well, let me say it. Is it more about the lack of UI, about the high complexity of the whole flow, or is that any other blockers?
Is a question for me?
Yeah.
So I don't see I don't see a lot of blocking points. On the contrary, so I think that if you look back in the past, there was not that many use cases for crypto. So, and without looking back to I think at Ledger, we are 11 years old. So it's kind of, in crypto years, it's quite a lot. So without going that long ago, there was not that many things to do. So it's true that a lot of people were thinking, I have crypto, I put it in a safe place, and I hope something good will happen one day. And the safe place was not an easy place because there was not that many alternatives. So that, I think, we tick the box. Now, if you look at the reality of engaging with crypto today, there's a lot of opportunities. The question is from security at rest, is security at use. So if you're engaging and signing something, are you signing the right thing? If you're interfacing with something on the computer, on the phone, do you have chances to get a malware, to get drained? Are the protocols you're interacting with safe, or themselves are the victim of an attack? And again, you have a risk. So I think this is number one question, and it's number one limiting factor for users. Should they be, by the way, institutional users? And that's why the Ledger Enterprise is providing solutions for them, or consumers, and that's why on the consumer side we're also providing solutions for them through Ledger Live, but also through the capacity to connect directly your wallet and your ledger.
Mm-hmm.
So the question of complexity, I think it's getting simpler and simpler. So we have new generation device that look like this. So it's format of a credit card, and it's a way to sign. And it's a way what we call to clear sign. So the idea that you will engage with something and you check on the screen what you're doing, you validate and you're done, I don't think it's an excess of complexity. So and we are reducing, of course, these steps all the time, but I don't think it's an excess of complexity because the alternative is the chances that you can use the funds. So it's not very seducing alternative. So the idea that more and more, should it be DeFi, should it be crypto projects in general, both on the institutional front and on the consumer front, require a third-party device that is quite a nice device. It's even a little sexy device, I think, on which you check stuff because it's the only way. It's the specifics is that the screen is controlled by the secure element. So it's a secure chip that shows you what you see and that controls what you do, what you see. It's the only way. There's no other way to be safe on signing something. So I think we have to accept it, but I don't think it's a limiting factor. And if you talk to institutions, especially people who have been in traditional finance before, there's a lot more clunkier system and difficult system than having to use a nice device like this. And for consumers, I think people got used to that. What they ask us is, okay, what can I do with it now? So putting it in motion, getting, as I say, security at use and making sure that more and more protocols, applications, destinations, projects are enabling a secure signing and secure connection thanks to compatibility with Ledger is our project at the moment. But I don't really see the complexity. Of course, we work on reducing frictions, but it is just how it should be.
Mm-hmm. Thank you. Well, and from that complexity, let's jump to another complex thing, probably one of the most complex and one of the most important, talking about the regulatory aspect, regulatory reality. And Eric, my first question out of here would be for you. So right now in US, we have US Genius Act, right, which prohibits issuers from paying any interest. Also, we have a MiCA, which bans interest on e-money tokens. And the question is, what compliant designs are you guys seeing on Canton network? Is it the tokenized T-bills and permissioned funds, or repo-backed sweeps, some third-party wrappers? And which of them scales first right now, and why? How do you see that?
Yeah, I mean, I'm not going to comment on whether or not I think it's good or bad to do the interest pass through, but I've always kind of thought of this, at least in my own mind, similar to kind of how your bank versus your savings account works. And the sort of seamless liquidity between the two for me is what's missing in a lot of the broader ecosystem. So, from the perspective of institutions, I would say the two instruments that are the most attractive are treasuries and cash. And the thing similar to my comment earlier about velocity, there is this focus on TVL in stables, and I think there should be more of a focus on their use. And if we were really helping a large holder of some treasury manage their portfolio in the most simplistic risk-free way, they would be 100% in something like a treasury until they exactly need money, and then they would convert exactly that amount out and spend it, and vice versa. And having completely seamless 24/7, no operational risk ability to do that, building that into the system, to your questions earlier about complexity, making that feel as simple as moving money out of my checking and my savings account, that's the sort of optimizations that I think we can help people make. We see this happening at scale in Canton already in the more traditional use cases. We have US Treasury repo use cases that are doing somewhere in the neighborhood of around $400 billion a day of volume. And that's small as far as the actual repo markets go. It's really big, in crypto terms. It makes us many multiples of RWA activity over all the other ecosystems combined. But collectively, we're all still very early. The opportunity is much, much, much bigger than that. And yeah, I think really treasuries are some of the most interesting early things. But what I try to remind everybody about in kind of the TradFi space in general is that I don't look down on any experiment that I see done in the space because
I think we'll
I think
just.
there are many
we've
different
lost Eric.
funds today. Oh, nice.
All good.
Yeah, anyway, we have lots of different types of money. We have lots of different types of money market funds. We have different maturities on treasuries, and they serve different purposes. And what a mistake that I find people make in the crypto space often is to judge two things against each other as if they're solving the same problem. So there are many opportunities for tokenized money market funds, because of the broader audience and the lower friction access somebody can have to something like that versus a treasury held in a broker dealer in the United States. And so it's not just the quality of the asset and what can I do with it, but you also have to take into account the friction and the audience. So there's no one size fits all, but generally speaking, I think that the first low-hanging fruit here is just for everybody to hyper optimize their in yield, whatever the right yield product is for them when they're not spending money, and they are spending money when they need to spend money. And I think the benefit of something like the Genius Act is it's very clear that money is this transactional item. I'm using it to do this transaction. And then once I'm on the other side of that transaction, I have a wealth of options to me about where to go in and out of yield. And just optimizing all those flows is a big short-term opportunity.
Awesome. Alex, and when people look into the Dubai right nowadays, Dubai looks like probably the most innovative from the regulatory angle, one of the most innovative area on the crypto market. But there are different kind of views on that. Some critics says that Dubai just buying innovations, right? But with buying innovations, they're losing the rules. So, and supporters say that it is the future. That's the way how everyone should play. Could you please share with us how it looks from the ground, and what are your view, the things which works well in Dubai? May they work same goods in Washington and Brussels, wherever else?
Yeah, I think so. Yeah, maybe to kind of paraphrase or rephrase is what is Dubai doing well, and is there truly innovation happening? We kind of touched on the previous point that this it's definitely out of date. This concept that it's just sort of Wild West, no rules. If anything, we're overregulated. I'll give you one anecdote: is that I produce content, and I've just recently had to register and get a media license to operate and just produce content, make a video, talk about the activities that we're doing in the UAE. So. And then, even another useful anecdote, if anyone's watching this and is planning on coming here for crypto conferences and planning to shill a token, for example, at Token 2049 on stage, like heads up, you might get fined for that. So it's like very much not like a do whatever you want kind of place anymore. And you got to be really careful with this because there's a ton of new rules being introduced all the time. Your question is, around like what works well, what could be replicated. I don't know. I think a lot of what is working well here is kind of inherent to like this market, this region, this moment in time. It is a global business hub, just physically, right, between Europe and Asia, right. So I could easily be talking with the Ledger team in the morning or in the afternoon, and then like talking with exchanges in Hong Kong. All in the same day. It's very easy to make a global business here, and then because of your transport hub, you get all the like infrastructure benefits of people being able to host direct flights from all over the world. When a token 2049 is on, you have all the infrastructure, and they've sort of built all of that out over time, and the hotels to be able to host everyone. So I think that plus, look, UAE is also like 96% non like local population, which means it is and has always been very like outwardly focused and like welcoming people from all over the world. It's a very like commercially minded country since for decades, and that means that there is an appetite for risk and experimentation and the ability to like be a leader and pioneer in a way that like neighbors like Saudi Arabia, which is the inverse, which is like 97% Saudi nationals, is very risk averse and like. So it's like this unique combination of like a bunch of things that all kind of came together. I think would be really hard to replicate in Brussels, for example. Like I just think culturally, it's just not even possible from my experience.
Mm-hmm. That's fair enough. Thank you. But let's express our predictions. How do you see in the next 12, 15 months, what realistically can happen in your markets or globally?
Who's
Alex
going first?
Alex.
Jean-Paul? Okay. Look, I know Eric was starting to talk about like corporate treasuries and
that's why I want to give him the last word here.
Yeah. So I'll give like my like regional perspective on that, because I was on a roundtable recently with like heads of corporate treasury like here in this region, and I would say like at least on this side of the world right now, like very few are even considering stablecoins like full stop, let alone yield bearing or like DeFi yield generating, and let alone like native assets like BTC, Sol, whatever. So I think that's like another cycle away for like true like global corporate treasury adoption into digital assets. But maybe the US is further along on that.
All right. And JF, how does the regulator looks from the France? What are your predictions for the next 12, 15?
Right. So we're proud and happy to be originally a French company, but France is not a extremely large market because of the size of the population, so we're really like global. And to this topic, I think the chance we have is that we partner and we welcome specialists, so people whose job is actually to run the services, to adapt to the regions, to manage regulatory. So we are much more like a platform. And by the way, I think the co-interview, the co-presenters today, we all have a connection with them one way or another. So I don't have too much of a position on that. What I see is that there is at a global scale, things are moving. They are moving on the institutional front quite rapidly. They have moved already for quite a while on the consumer front. And then the question for us will be to partner with the right partners and make sure that the services featured in the application of the wallet also that can be connected to the wallet are the right ones. And we have also a question of distribution, so for the device, because you need to be able to buy it. But with excellent distribution, for example, in Dubai, but also in Belgium. So there's no limitation from that point of view.
Mm-hmm. Thank you. Eric, for you personally, if you don't mind, I want to specify that question. As Alex already teased, digital asset treasury firms is an extremely hot topic right now. It's a huge new narrative for the market. It's not new, right? But we see this rapid scale, the curve of scaling in counts in numbers. So could you please share your expectations in the next year, next 12, 15 months on the regulatory landscape, what realistically can be changed, and probably if you could even specify that and share your vision regarding the digital asset treasury firms. Is it something which will stay with us for a while, or how do you see that?
If you don't mind, I'll actually respond to Alex instead. I'm not a DAT expert, and I don't pretend to be one. I think I find them a very interesting sort of capital formation experiment, and I watch very closely and very carefully because I think there's a lot to learn there. But I definitely don't pretend to be an expert there. But on the adoption on the corporate treasury side, I think it warrants a bit of a deeper discussion and a little bit of introspection on the crypto space. So yeah, I've been in crypto since 2009, and so yeah, I'm in my fourth or fifth wave of here comes the institution adoption, and I've seen a number of reasons why it hasn't happened in the past. And the theme that is consistent through every single one of them is that the tooling presented to them and the ledgers presented to them are fundamentally not fit for purpose. Very, very basic things are not found in any other ecosystem other than Canton. Data privacy, selecting your validators, setting your fee rates, independence and sovereignty of your app so you don't get DDoSed by Pepe coin going crazy and interfering with your bond issuance. Very basic sort of stuff that you need to run a responsible business has not existed in the technology presented to them outside of what exists in Canton. Now, the other theme that was fairly consistent in the past was, I would say, kind of not really a regulatory landscape for it or a willingness for it. It was very experimental. But what's happening right now is a full-fledged embrace, especially in the United States. I'm taking a very US lens here, an institutional lens. We made an announcement a few weeks ago. I'm losing track of time. Sorry for the lack of precision, but about doing a US Treasury repo transaction using USDC and treasuries natively on-chain digital treasuries with the DTC on a Saturday between two large institutional firms. The work there will continue. That project will get bigger and more relevant. Definitively within the next year, you will see trillions of dollars of treasuries on-chain, native, being used regularly 24/7. Things like financing, things like creation redemption of stablecoins, things like creation redemption of money market funds. Too often people are looking at the front end of the crypto native assets, so the digital money market fund that's out on the chain, and don't appreciate that on the back end, they're still completely hamstrung by TradFi rules. Even something as simplistic as a stablecoin can only be created in the US Monday to Friday, 9 to 3 o'clock, when I can deliver funds to them through the Fedwire. So when you look at the back end of these crypto native assets, they're starting to hit, I won't call it a glass ceiling, but you're starting to hit risk levels of, actually, I need to convert hundreds of millions of dollars of this on a Saturday in order to do my business efficiently. And that capability isn't there. So it may not be pure corporates that don't participate in crypto that come in the next 6 months. But with crypto being a multi-trillion-dollar industry, the largest participants have become large institutional firms if they weren't already to begin with. And they are starting to behave and act like more traditional financial firms, but with the muscle memory, the desire, and the interest to do a lot more stuff on chain. So I can say with near certainty that we will see massive corporate adoption of treasuries, whether that's institutional trading or prime brokerage or anything along those lines. I won't say where the earliest green shoots will be, but it will happen in the next 12 months because of all the conditions are there and the capabilities and what they need from a functional perspective is there.
Thank you. That's a great overview, and finger crossed for that happening. And all right, let's switch the topic. Let's talk a bit about the infrastructural part of the market. That's kind of more our kind of where we are more familiar with, because we are an infrastructure company. And Jeff, we have a kind of joke on the crypto markets. I don't know, have you ever heard about that or not? But people saying that wallets, hardware wallets, are like gym memberships, right? So theoretically, everyone knows they should have one, but very few actually use them, even if they got. And right now we see that Coinbase offers almost 11% of yield for the stables just with the click. And how do you see in Ledger, is the maximum security, about which is hardware wallets, is still worth for the most of the users? Or is it, I don't want to say that the war is lost, but we've still got an incredible number of people who's using hardware wallets. But is it kind of something for a future still? Is it still matters so much?
So I like the question because it's quite a provocative question. So, that doesn't correspond, luckily in a way, that doesn't correspond to the reality. If it will be like this, we will charge a subscription for the wallet. We will not sell the wallet. So no, the reality is very different. So what you see first is that unlike gym, people actually are using it, and they are using it more and more. So when you look at the number of users that are engaging with the application, or that are engaging with a third-party application by connecting their wallet, it's extremely used. And it's true that some people, as I said in the introduction, were using historically Ledger to store some crypto because there's nothing to do with crypto. But now it's been seriously like at least 5-6 years that top protocols of today have existed, yield others that you can swap, you can trade, and there's a whole what we call DeFi environment, which is broader than that. Is everything where you can connect a wallet, and that enables you to do something that has been existing. So in parallel to that, true, you have centralized exchanges that are large. I think they have their own issues, by the way, in terms of competition, because now you have the kind of fintech going after their lunch, and you have institutional finance, and you have banks, and you have ETF. So there's a whole part which is like hyper centralized, where you have your customer of someone. It's a bit like being customer of your bank. You're interacting face to face. They propose you a product. The product can be good, can be more or less good, can be a bit like incentivized in the beginning to lock you in the. Sounds like finance, like TradFi all over again, huh, to me. So yes, it's a bit like in retail. You can say maybe one day 50% of e-commerce is Amazon, but you want to buy everything on Amazon, or is there space for something else? And there's more than space for something else, because what we see is actually DeFi is growing faster than CeFi. So I think the reality is completely different. The problem after, as I was saying, is when you engage with such experiences, there are two risks. There is the risk of using only a computer or a phone, so that your wallet is only on your phone or your computer, and these devices are vulnerable, and I don't need to make the list of all the vulnerabilities. And then the other risk is that who you are interacting with is not anymore who you think they are, because they got hacked, they got replaced, they got this the list is infinite and growing of all this. So if we want this to continue, and if we want choice for users to continue, if you want this capacity to interact with different protocols, with different solutions, we need to find a proper solution for that. And this is applicable both for institutions and for individuals. So for institutional solutions, we have the Ledger Enterprise Platform is very agnostic. So it's not something that comes with custodian services or with other regulated services. It's something that is adapted to your need, but puts you on the safe side because of the signer. So the wallet, at the end of the day, the wallet is on the blockchain. If we want to explain that, and then you have ways to interact with your wallet, and one of the ways is actually to check that your address is yours and to sign transaction. So using a separate device, which is this one here, is super basic, because if you do everything on your phone or your computer, you're at risk. So it's quite different actually from the funny way you put it. I think it's when you think about wallets, there's a space for wallets, and there's more and more needs for wallets, more and more opportunities for wallets. Wallets like a consumer version, wallets in another dimension like a enterprise version, and each time, I don't see a way if you don't have a separate piece of hardware with a secure screen to not only sign but check. So what you can do, you can read on the screen what you're doing, and if you're reading that on your phone or your computer, it's not gonna be nice. So that's but to me, and maybe I'm biased, I don't know, but I think it's cool actually to have your personal screen where you check everything. I think it's a nice thing to do.
I actually want to support you here, JF, a little bit. So like the way I've always thought about this is like self-directed finance means you can kind of go swim in the pools where, you know, your large centralized provider may not be yet or may not be able to go. And, you know, a lot of what's going on in crypto is like the bleeding edge of exploring. You know, you asked about DATs. There's all sorts of interesting capital formation structures on chain and products. And, you know, the pace of that happening, you need something as simple as, you know, the interface of interacting with the asset or the smart contract, and to be able to do it securely and safely, where you're taking the risk of vetting that idea and being the first into it. So I think there's a very strong case for both. I find, again, too often in this space, we pit things against each other, where the answer is usually or for different purposes. And the personal wallet is a wonderful way to go. I mean, especially if you have a secure partner like Ledger, it's a wonderful way to go into the bleeding edge of what's happening in an ecosystem. And, you know, you might get taken for other reasons, you know, maybe it's a rug or, you know, something like that, but not because you didn't know how to interact with it safely and securely.
Yeah, it is. And at the end, I agree, just very cool to get such a sexy device in your pocket and be able to interact with that neither with an app on the phone. But I really like your statement, Jeff, about the smartphone, which is the only one computer, right? And Alex, we know you guys connecting right now. How many countries you're connecting? More than 25? I assume, right?
Well, yeah, if you're referring to like our developer ecosystem or like founder support network, that's in more than 25 countries. Obviously, like Solana, the network is available anywhere you have an internet connection, but yeah, we're like on the ground supporting teams in 25 countries all over the world.
And most of these countries would be fair to kind of consider as an emerging markets, right? Where the smartphone is the only one computer. How do you see the ways, the most important things which have to exist on these markets for kind of adopt yield to the users?
Yeah, and I think like the Solana ecosystem has been good at incubating a lot of like very consumer focused products. So in this like space, I would say, I mean, this is across the board. I'd say these even hold for institutions, right? But like first is like cheap fees, right? It doesn't make sense that you have to spend hundreds of dollars to like open and then close like a lending position, which wipes out like a significant amount of your return. Like this from last cycle was totally unacceptable, I think, and is getting solved with cheaper, faster networks. I'd say the second around tight integration with payment networks. So I think like Ledger has their spending card. I think Eric touched on some of these integrations as well, right? Like both, like ultimately, like there's still a huge the vast majority of transactions are happening in the fiat world, and you need that like seamless hop between the two, right? If without that, people don't consider it as, it doesn't feel like real money. You could be like parking your stables in an earnings account, but if you're not able to seamlessly use that to like then buy your groceries or whatever you're doing, and then that's not good enough. I think the final one, and the thing, something we touched on, from different angles, is just risk, transparency of risk. Where is that yield coming from? Is this a basket of meme coins, and you're just speculating on this asset and skimming some of the gains, or is it things like Henri, which is backed by reinsurance business, which is like hundreds of years old industry, super mature with predictable yields at like 12%, but that's been brought on chain, right? These are very, very different products, and the way that you like disclose that risk, describe that risk to people, whether it's like you and I, or a more sophisticated money manager, We just have to get better at like the language and like the presentation of that risk.
Thank you. And Eric, coming back to the American institutions.
Sorry, just before you do, earlier the question
Okay.
about complexity, I had an input to it, but what Alex just said actually really made me want to say it even more. The number one thing I hate about the crypto community is that we've reinvented every word we've already had good words for in finance for decades, if not longer. And like to your point, Alex, about what am I holding? We have quite robust disclosure regimes and reporting regimes and processes already. Like, bring them on chain 100%. Find ways to make them more efficient and the quality of the data better 100%. But for the love of God, community, please don't create some silly word about this and like pretend like it's something net new. Just do the things we already have and do them at scale. Do them well. But yes, we completely need it. But please don't call it yield farming or like data yield farming or something. Like, just please don't do that.
Yeah, that's the nature of the whole crypto, right? Reinventing the words, the terms. Eric, could you express us how you right now trying to shuffle to different worlds? Again, let's use your clients' examples. The JPM, they build permissioned networks, right? While Aave, they stay as fully open to that time. And Canton tries and aims to connect both of them. So how do you see what is the minimum bridge which needed to make the yield portable across this world? And who should operate that?
Yeah, I mean, I guess I disagree with the framing. I mean, it's not your fault, Alex. It's just that in general, again, we kind of run to these two binary sort of positions and pit them against each other. BITL is a gated product. It's permissioned. It's not a freely transferable asset that anybody on Earth can hold. And the fact that it's on ETH and Solana doesn't make ETH and Solana permissioned networks. So people have really conflated giving the tools for the issuer to set whatever rules around what they're doing to be fully compliant and achieve whatever outcome they need to do with saying, okay, the ecosystem is locked down. So this is exactly where I think Canton shines, is that we give much more granularity over what you can permission while still being part of a bigger interoperable network. So I always position the network as completely permissionless, and obviously there are assets within it that are permissioned at different levels. So you can have an Aave coexist with a JPMD in Canton quite easily, and you can compose transactions between them quite easily. And in fact, we have stuff like that. We have treasuries that the DTC have tokenized, and we have totally public, permissionless, completely transparent assets like Canton Coin, and you can compose those two together and not violate the different control and data permissioning regimes. So again, it's about giving the tooling to the people to get the outcomes that they want, and then fostering the connections between them, because there are real opportunities to do to connect these things. There's Aave is moving deeper and deeper into the RWA ecosystem, because that's what the next horizon. I think the product's even called Horizon. The next horizon of opportunity is to go into this much bigger by notional value ecosystem of RWAs.
Is it about? I'm still curious to see from your angle who should operate that process, who should set these limitations.
I mean, the issuer or the operator, it's entirely their decision. So, like I always try to draw an analogy to the internet. The network is completely public and permissionless, but Chase.com is not. So, what that means for me is just because I have a browser on the internet does not mean I get to see everybody's bank account balance at Chase. And should I be permissioned by Chase to have a bank account, they also determine what I can see and what I can do. They see everything within their domain, but they don't see anything at Bank of America. That sort of asymmetric permissioning and boundary and view allows you to build a heterogeneous ecosystem, because those permissions might work bank to bank, but they definitely don't work for BitTorrent or for CNN, and you need to give the ability of the party bringing to network those tools so that they can set exactly for their business model, their regulatory requirements, whatever it may be, and that's almost always completely unique to the operator or the issuer in some shape or form. It's a big part of the reason that I think you see a lot of these corporate chains being launched is that they want to do things like determine exactly who their validators are, set certain permissions around who can access and under what time and what they can do. And they want to set gas fees or chain fees in different currencies or in the way that they want to do it. They want to create their own incentives. All of that's 100% possible on the mainnet of Canton. But in other ecosystems, you generally have to go fork and create a new instance. And the downside of that is that you're fragmenting the very ecosystem that you're trying to help build network effects around. You're forcing a user to determine, well, am I going to go to Base or ETH to do this? And you're actually undercutting the network effects of the ecosystem if the infrastructure is always physically fragmented. I've always found that to be one of the most compelling things about Solana is their sort of very strict focus on doing things in a composable way and not fragmenting their ecosystem. My words, not yours. That's my interpretation. Yeah, I think that it's wrong to say, oh, this is a permission network, or that's a permission network, or this one's permissionless, and instead just again accept that there are different design decisions for the outcomes that you're trying to achieve, and they're all equally valid.
I'll add on that, like from the other end of the spectrum as well, because yeah, Eric, I would agree, it's a false dichotomy, like this, one or the other, because on Solana you also have like token extensions, and you could launch a token that has like very strict rules, right? Like that only like these specific people can touch it, and like no one else can do anything. The examples that you highlighted, so it's a full spectrum, and it really ultimately like depends on what the issuer or whoever the asset controller is decides to do with it.
Yeah, this whole debate that was in the Twitterverse, I think it was last week, between DeFi Llama and Figment and Figure. I think it's like so silly. It's like the classical tribalism. We want to debate, only the way we do things counts, and that's why we don't include their figures in what we do. And I think that's just such a mistake. I think that all of this stuff is equivalent because we're talking collectively, everybody on this call, everybody listening, everyone thinking about joining this ecosystem. We're talking about rotating the trillions of the world's economy on chain. So collectively, how much have we achieved? And every dollar should count. Is, JP Morgan coin the same as Athena? No, they're not the same, but they are both really interesting and have different properties, and you should look at them side by side. Cagney and their team are doing a wonderful job bringing those products on chain. Do they have different characteristics than some other permissionless assets? Absolutely. That's why they are able to scale and achieve the outcomes that they are. Instead of looking at all these things through a lens of judgment and competitiveness, we should be saying, okay, that's actually very interesting. What design decisions did they make that helped them be successful? That's different than the design decisions being made over here. If you exclude this data or you try to caveat it or stick an asterisk on it and say, this doesn't really count, we don't care about it for XYZ reasons, I think you're completely missing the opportunity. And again, a little too in love with yourself, similar to my opening comments around the stablecoins. $250 billion in absolute terms is a big number. In relative terms to the global economy, it's nothing. So we've got to zoom out, think about the bigger opportunity, support each other's differing approaches. There are pros and cons to all of them. There's no good or bad. There are trade-offs. And we could all learn a little bit more from each other and put all these things together. Stop excluding them. So that's a like public versus private dichotomy. I don't like it. Just it's on chain, okay, with different decisions. So just consider it all through the same lens, and everyone would get a little bit smarter thinking that way.
Yeah, this is definitely a brilliant statement. We have it's great that in crypto we have a wide spectrum of solutions. That's another reason why even on the custody side, we have a self-custody, we have a licensed custody, we have an MPC ways of custodize your assets, and there are no right and wrong ways right? As you said, there are just different ways, and as a client, you may prefer which fits better to your current needs. Right now, you may collect and use multiple. And Jean-François, from that, looking from that lens to the market, from custody, self-custody, MPC side of the things, on the ledger institutional side, for institutional clients who values yield, who absolutely values safety first, where do you guys, and I'm still coming back to the question, who's drawing the lines, who's setting the limitations and the rules? Where do you guys in Ledger draw this line on the opinionated defaults in Ledger Live? So how the validator curation should work, what are the slashing, warnings, how the auto compounding, etc., how all these components should be set on the defaults, and how do you think about that?
I think there's two aspects. So you're asking about like the Ledger Live, like the application, and there's also the enterprise side. So on the enterprise side, I think we already enable people with really a governance and security infrastructure at multiple levels. So for large clients, for mid-sized clients, and adapted to their practice, should be on chain. Or do they need a vault and a full governance? So that's one thing. Then I think the question was a little bit more like on the services that are available through the application. Here, I think what we are asking the providers who are present in the application is transparency. So take an example. If people start to discuss BTC staking, there's no such thing that BTC staking. You cannot stake BTC. So you can get BTC yield, but no staking. So this type of shortcut, I think we'll ask providers to not to present that to customers, because it can be misleading. So it's an example because the transparency matters. So I think people need to understand what they engage with. Transparency matters because it's also what you will see on the screen of the device. You'll tell me I'm obsessed with that, but it's very important. So when we say clear signing, you see what you engage with. You see the outcome. You see something written for human, not just a hash. So walking the talk of what is offered to customers is a requirement, because the hardware function like this, and the screen will show you what you're doing exactly. And it's also a requirement because it's our positioning. So we were talking a bit earlier about the difference between wallets and something more centralized. Something more centralized, well, you trust your bank to do good with you. No one is evil. Okay, great. There you trust what you see, and you need to be able to compare. But after, what is the practice? Is it better to do things one way or another? Is it more competitive? Is it what people will look for? I think we are bringing the tools to compare. So we have this earn section inside the Ledger Live where you can compare and you can see the different possibilities. But we don't have a party pre on how it should be exactly and what is it. So I think that's the beauty also of using a wallet, even within the app, is that the wallet is side by side with you and is helping you navigating. But we don't have unless, I mean, of course, nothing crazy should ever happen. But as long as things are reasonable and they follow basic guidelines, it's a question of choice for users, and then the choice comes from clarity.
Great. And Alex, how does it look right now in the Gulf? Is self-custody ideology is still something people really care about, or is it not? And if that's the case from your perspective, what do you think moves this needle mostly today?
Look, I think there's different groups. The average retail consumer is totally like happy to just abstract this away and leave their crypto on an exchange. But then, like, my community audience is very crypto native and says not your keys, not your coins, and will die with their ledger in their hand. So I think how do you shift the needle on this? There are teams that are building really exceptional software that improves that UX. So Fuse Wallet, F-U-S-E, is a really good example of this. They support Ledger as one of the multiple security methods, right? So including iCloud signature, your Face ID, and a smart contract wallet, which is technically self custody, but then like has additional protections in place. So they really are trying to position themselves as like a replacement for your bank. It's a savings account. They really vet the yield opportunities that are coming in there, and they take a very opinionated view on like what they expose to people, which is a way to kind of minimize risk, I guess, to people from the full kind of Wild West experience. Another example would be Cast Card, KAST. This is one of their physical cards. Multi-chain, so you can accept USDC, USDT on, I think, like all EVM L2s worth talking about, and Solana, obviously. But they just make it very easy to spend your stablecoins. So tight integration across, like, I'd say pretty much every country that is accepting Visa and MasterCard, and you can pay with Apple Pay and Google Pay. So those are the two, I think, that are really like pushing the frontier of the user experience. So it feels like a normal like bank experience, I guess, but faster at the speed of stablecoins.
Thank you. And I really enjoyed today's conversation because we get this rare chance to jump back and forward from one to another pole of the spectrum. And Eric, I got a question for you. In another pole, on the American institutional side, on the bank side, how do you see what finally gets a bank risk committee say yes? Is it kind of insurance, first mover custody, first mover case study, some custody solutions, standardized attestations, public data oracles, what it is? Could you give us a couple of examples?
I mean, I actually think this is a very simple answer. The first thing is it has to solve a problem in a material way, which has one of three outcomes: saves them money, makes them money, or reduces risk. And the second is that the solution has to not introduce new risks that they're not comfortable accepting. So meeting the bare bone minimum requirements that they have for doing it in a safe and secure way. It's not to say that you can't do it in a creative way, in a new way, but you should not be introducing new risks to them that they don't currently carry today in a material sense.
Got it. Beautiful. That's a great simple answer. And going to the end, I want to ask every of you, how do you see, guys, if the 50% adoption is the right prediction? Well, it means that we need a X5 lift in the next few years. How do you see one thing which must happen in the next, again, 12, 15, 8 months, which we really need to make this real? And JF, if you don't mind, can you go first?
Well, that's the same message, but having choice, choice and clear choice, enlightened choice, something that you don't feel is a constraint. So and clarity about what you do. So use a wallet and use a device, a secure device with your wallet. And the innovation, I think, will take care of itself. I think there will be something for everyone, I think, in that space. So I will believe in that, in the market coming up with solutions. Should it be the blockchain? Should it be the project? But for accessing that and for innovation to happen, I think wallet are best position, and wallet comes with a form of safety, and you're good.
All right, Eric, your view? What must happen to push an adoption to X5 out of here?
We got to break out of the casino. If it's just the crypto casino chasing its own tail, it's a fairly fixed pool. I mean, it's growing as the volumes pick up, but if you really are betting on this ecosystem taking over, it's gotta start to get into the real world flows.
Perfect. Alex?
I'll hit on it was something that we covered earlier, is like language and a common understanding, between like traditional and, like, say, the new digital asset, economy. I think I tweeted this a while ago, like a couple weeks ago, but like the rarest skill or like the most valuable skill right now is the ability to coherently speak to both like the traditional financial world and the crypto natives, and somehow like marry the two and help them come to a common understanding. So I think that's got to be that involves changes. People spending time in other ecosystems, going to other events that maybe push themselves out of their comfort zone on both sides. Marketing teams also adapting to like a broader like set of language that kind of pushes people to challenge their like existing mental models. But we need that like fusion of these two currently from my perspective, very distinct worlds.
All right. And well, I believe everyone was trying to be positive, look into the market, but we still have to think about the risks. And if we'll try to name the black swans, something which could not just slow down on adoption, but literally wipe the stablecoins yield out of the market, what it could be. Eric, if you don't mind, could you go first?
Man, definitely not an area of expertise as well, but
Just a guess.
I think the more experimental things around using really high yield, large, over levered, over looped products. Just be careful about the true liquidity signatures of those asset classes, and tread carefully. But I mean, generally speaking, these things are pretty stable. The yield is coming from very secure places, so the preponderance of the things that are in the market are doing it through safe and secure ways. There are some exceptions, of course, but for the most part, things are pretty solid.
Awesome. And I see that we just hit 10,000 people on that stream, which is great. And I believe, because such a huge attention, stablecoin yield will never gone. But still, JF, how do you see, do we have any black swans risks on the market?
I think to go back to something that Eric was saying is they need to be a use case. So the use case cannot be just a closed loop, like you get yield on something that is just like this. So I think I was saying it in introduction, the fact that stable is used for more and more for payments, for peer-to-peer transaction, that is used for trading, for swapping, all this dynamic and this underlying use case. Then of course the yield will come on top. So it's not just like a closed loop thing. So I think the development of primary use cases and using crypto almost like in everyday life, using crypto for business to business payments, using all this, I think will create utility, and with this utility, the yield will be orthogonal to that, and the two will combine in a nice way. So I think we have to progress on both.
Awesome, thank you. Alex, could you share your view?
I mean, the nature of the question is that it's like what the thing that's impossible to predict. So it's really hard to answer the question, but I would tend to agree. Look, like the sudden surge in highly leveraged trading platforms. I think now the new trending DEXs. I'm not going to like name any names, but like 100x leverage. That introduces a lot of volatility, a lot of incentive to introduce volatility, and with that brings it will stress test the system in unexpected ways. So I think possibly not the ultimate root cause, but like definitely one of the contributors to a systemic correction will be leverage induced.
Agree. Yeah. And once again, thank you guys for joining us today. We are coming to the last part, which is the rapid fire section. Just one single thought, rapid answer from your end. Alex, you're going first. One single thing Dubai does that everyone should replicate immediately.
Just fast visas. Get it? Like that is a trivial thing. Just give them a visa, let them come in.
All right, and the corporate taxes, I believe.
Yes, that helps.
Another one, Eric, for you. The boring infrastructure detail that actually determines who wins. It's to talk about the sexiest things on the market, which boring things are the most important ones?
I mean, boring is definitively privacy, and importantly, not anonymity. So the very boring spiel of some people have to know everything and others shouldn't know anything, how that works.
Brilliant, brilliant. And JF, last for you, compromises the industry refuse to make but needs to.
I'll be a bit pro domo, but guys, use a device with a secure screen to sign your transaction, and life will be good. And I think it's not only our life; it's an imperative for this industry. So
Perfect. Great. Thank you, guys. Thank you once again. That was such an amazing panel. I've got the privilege to be with you today. Thank you for covering all of that. And well, let's continuously deliver, let's continuously develop on the market and push frontier of stablecoin yield forward. It was great to see every of you. Thank you.
thank you for the invitation.
Thank you.
Cheers.